You ever check your investment account and instantly feel sick? Like, I knew I shouldn't have looked today. Like that little red arrow that's pointing down, and now you're wondering, like, man, did I make a mistake? Is investing the right move anyway? Or man, am I about to lose everything I worked for? This is called a market dip. And just because you saw the market drop, that does not mean that you're doing anything wrong. Okay? It means that you're investing. That's a part of it. And investing is pretty filled with emotions, but I don't feel like they talk about it enough. So we're gonna talk about it. Hey goalies, welcome back to the channel. This is where we keep it real about all things money, confidence, and financial success. If this is your first time here, I'm your girl Nia, the Coin's Confidant, and I am all about helping you build the confidence and clarity to crush your money goals. I need a favor. Make sure you hit that like and subscribe button. Drop down in the comments your thoughts while you're watching this video. Let me know what you thought. And if you have questions, drop your questions in the video. So today we're going to talk about why does the market drop? Like, what is that? And importantly, why that does not mean that you are failing. So this is a video that will be part confidence pep talk, as all my videos are, part investing education, and all the way practical the whole way through. So this is where we're going to start. The first thing I'm going to do is I'm going to define what is a market drop. Because you're not going to just scroll past that like you just didn't say that. A market drop is basically when a lot of different stocks are dropping at the same time and they're in the red, which means they're losing value. So when you purchase a stock has a certain value. Like maybe I purchased this stock at $50, but in all the stocks I have, like the market is going crazy. You look at all the most popular stocks and they're all in the red and everybody's in a frenzy. That happens. And that's called a market drop. So you might go and look at your stock and it might have dropped in price. That's the best way to look at it. Basically, the stock's value are dropping. Okay, so now that we got that defined and got you a good idea of what a market drop is, now we can get into it because I like to make sure you understand everything I'm talking about. Market drops are normal. Okay, they're not new, they're not personal, it's not against you, and it does not mean that your financial future is doomed. So I want you to understand that. So I'm going to give you a few stats that I want you to remember and think about. On average, the stock market drops about 10% every single year, and that's called a market correction, and it happens regularly. It's a part of the process, okay? And I want you to imagine if you freaked out and pulled your money out every single time that it dipped, you never get the money. You never would give your money the chance to recover or grow. So let's look back and I'll give you a few examples that this you can Google and you can research for yourself. In 2008, and if for those of you who don't know what happened in 2008 was a big financial crisis. The housing market dropped, the stock market dropped. I mean, it was some people who lost so much that they unalived themselves. Like that's how real it was. It was just a lot going on, and people were going into foreclosure like crazy after this year. It was a bad time financially for a lot. And in that time, in 2008, the market dropped more than 50% during that housing crisis. So, but if you had stayed and kept your money and kept your investments, it would have recovered. It actually recovered more than double by now. Second time, in 2020, we had a whole panorama. Okay, we had a whole panorama. During the panorama, the market dropped about 34% in just a few weeks. So that was scary, I'm sure. But guess what? It bounced back faster than anyone could have possibly imagined. The point of all of this is that if you look at any 10-year stretch in the stock market history, you're going to see dips, but you will also see recoveries and growth. So that's why I always say, like, it's not necessarily about time in the market. It's about the time in the market. So you're not looking to outbeat the market or outsmart the market or get the best time. Like, that's not what you're doing. This is not a competition. This is a strategy. This is a calculated strategy that you are using to help you achieve your financial goals. I do get it. Fear is real. And I don't think they talk about that enough. Like how much emotion, especially if you're someone who's new to investing and you're just starting to do this, and you're looking at this money that you worked very, very hard for, and you're like, you start sweating, now you're like, oh, I should just pull it out. And maybe you've said to yourself, like, I can't afford to lose any more money. You know what I mean? I already feel like I'm behind. So you're thinking, what if I mess this up? You don't want to start investing only to regret it completely later. The truth is, though, you can't avoid every day. Like, I'm here to be real with y'all. We keep it real on this channel. This is the channel where we talk about money. Like, we have real conversations. And I'm going to be real with you. You cannot avoid every market dip. Like, you would have to be like this savvy investor that got a little bit of what they used to call it, ESP, a little bit of telepathy going on to be able to know what's going to be said, or the thoughts that people have of what they're going to do, to know what's going to happen in the market for every stock that you own. Okay, so you can't avoid the market dips, but you can learn how to manage your emotions so that those dips don't really control your decisions, because we all know that's the worst time to make a decision. So let's talk about volatility. What it's not. Volatility, it just means that it's movement. That's the best way to put it. It's movement. It doesn't mean that it's bad. It doesn't mean that it's broken. It just means that the price is going to go up and down. Sometimes it might do it slowly. Sometimes it might be faster. But that's it. So when you're looking and you're researching stocks or in index funds or ETFs, and you're looking at the history and the historic value, that's the volatility. How much did it go up? How much did it go down? It's like riding a roller coaster, to be honest. You're going to have some highs, you're going to have some lows, but the goal is to stay buckled in, not jump off in the middle of the ride. And let's be clear too. I want to be clear. The market dropping also does not mean that you're a bad investor. Okay? It doesn't mean that your plan isn't working. It just means the market is doing what it has always done. The market is marketing. Okay, let me break it down for you even simpler in 3 words. The market is marketing. That's what it means. If the market is dipping sometimes and growing sometimes, that's what the market does. Okay. There are a few mistakes that I've seen clients do, or that people make a lot of times when the market drops. And the first one I'm going to call out is panic selling. So this basically is when, if you see red numbers or you see the value dropping, you get scared and you sell everything to quote unquote cut your losses. But what you don't realize is selling is actually what's locking in the loss. If your portfolio dropped, let's say $1,000, and you sell them all, now you just guaranteed the loss. But if you were to stay in the market, you're now giving your money a chance to recover. Because what did I just say? Historically, yes, the market drops and then it recovers and grows. And sometimes it doubles the recovery. And that's when you would make more money. When the market is low, they always say that's a better time to sell. I mean, it's a better time to purchase. But I think it's more so, this channel is more so about dollar cost averaging, which basically means you're buying when it's low, you're buying when it's high. You're more focused on a long-term strategy that just consistently purchases. It's kind of like what you do in your retirement account. They take the money out of your paycheck every time you get paid. They contribute it to your plan. It gets invested. So it's just getting invested consistently. So whether the market's high, whether the market is low, the goal of it is that you're consistently invested in, and over time that money is going to grow. Okay. The second mistake that I see people make all the time is checking your account every day. Like, I know it's tempting. I know you want to see that money grow fast, but logging in daily is like checking your weight every hour during a lifestyle change. You're going to drive yourself crazy, and it doesn't help. It's not going to help you reach your goal faster. Instead, why don't you try scheduling like a money check-in, which you should be doing anyway? Maybe quarterly, once a month, you check in, check your numbers. Feel free to keep a log. If you're more of a type A person and that feels more comfortable for you, and it makes you feel a little bit more at ease because you can see the number growing over time. All the things you have to work what best for you. The third mistake I see is letting the media create urgency for you. Every time something happens in the economy and our headlines are screaming recession, crash, oh my God. But you have to remember that headlines are just that. They're designed to get clicks and ratings. They're not there to help build your confidence or increase your investment education. You're here building wealth. You're not chasing drama. Okay. So another part of it is the emotional parts of money management. This is where a lot of people struggle. And that's why I feel like it's not talked about a lot. Like, a lot of people get on and tell you, like, oh, don't get that coffee. They don't know that you don't like your job, and that coffee is the thing that's keeping you sane and has helped you not curse anybody out at work. That's the part they're not talking about. So that's why I'm always a person to say, like, check on your values, see what motivates you, check on who you are as a person when you're making these decisions. So we're going to give you a few practical things that you can do before I end this video. So the first thing you can do is create your own personal investing mantra. Y'all know I'm an affirmation girly. You know I am all about speaking positivity and putting positive energy over myself, my finances, my life, all of the things, because I truly believe that it's very powerful. And in my personal opinion and my own life testimony, it works. But it does take you actually believing what you say. And that's the part I think that people don't talk about. Like, they talk about saying affirmations and doing different things, but you have to believe what you're affirming. You can't affirm it and you don't believe it, because then it's not going to happen. You have to know within your heart, despite what it looks like right now, that it's going to happen. So create some mantras for yourself. So you can say things like, my goals are bigger than this dip. You could say, short-term red does not cancel long-term growth. Put it on a sticky note, put it by your computer, on your desk, everywhere that you can. The next thing you can do is don't make decisions based on fear. You are most likely to make a financial mistake when your nervous system is in fight or flight mode. That's not a good mental space to make decisions. Before you make a move, pause for a second, take a deep breath, sleep on it, give it 24 hours before you do anything. All right. Then another thing you can do is remind yourself of your long-term vision. What is your why? What are we doing this for? Are you investing for retirement in 20 years? Are you trying to build funds for a house in 10 years? Then if that's the case, why are you worried about what happened today? Because what happened today is today. If you make journals, or you like to journal and reflect, here goes some prompts for you. I'll give you some prompts that you can use. One, you can ask yourself, what's one time that I pushed through fear and was glad I stayed the course? That's one prompt for you. Another journal prompt is, if this was your friend going through this and your friend venting to you and talking to you about it, what would you tell them? What would you say to your friend? And then lastly, you can say, what's one action that you can take today that will help you remain grounded in your financial goals? Because what I want you to know is, you didn't start investing for quick wins. You started investing because you wanted more freedom. You wanted more stability. You wanted more options. And that doesn't come from perfect timing. It comes from consistency, confidence, and staying the course. And let me say this last thing for the loud people in the back before I get off of here. Market dips are temporary. Okay? Your future is still secure, and your plan still matters. You're still the smart investor that you was. So don't forget, next video coming in this series is going to be all about practice. practice without pressure. So we're going to learn how we can practice investing without the pressure. And then we're going to build a simple game plan and like that, what that looks like for you. Okay. With that being said, until next time, keep showing up for yourself and crushing your money goals.